Guest says Michael Burry may be right about some specific companies, but the biggest risk remains underinvesting compared to overinvesting. Joining me now is Daniel Newman, CEO of Futurum Group. Daniel, great to have you on Overtime. Finally. Okay, so this is kind of pitting NVIDIA and its set against the big cloud players, the hyperscalers, because if you're NVIDIA, you want people to need a new chip every couple of years, but if you're the cloud players in their accounting, they want to be able to convince us that, no, these chips are going to be good for a while, right? Who's right?
Well, I think they're both right in part, John. And by the way, great to be here with you. First of all, NVIDIA and Jensen will get on stage and he will absolutely say, look, the more you buy, the more you save. The next generation of chips is going to be exponentially more efficient, more tokens, better economics. But at the same time, you have to weigh that against the CapEx, the cash burn, the depreciation impact that it might have. And you have to weigh it against what customers need. And in Seema's report, she said something that is really important. And what's important is we don't know 100% yet how these workloads are going to impact these newest variations coming out from NVIDIA, from AMD. What we do know is that TPUs, we know that a number of older generation NVIDIA chips, the V series, A series, are still being used and still able to command meaningful commercial pricing from their users. But this is all about supply and demand. Right now, there is no equilibrium. So every chip that's available right now, there's someone out there that's willing to use it for an AI workload. If we truly meet some type of equilibrium towards the end of the decade, which is when we expect that to be possible, this is where that depreciation issue could get really significant for companies like CoreWeave that are taking 6 years. Go ahead.
I just wonder, for the likes of a CoreWeave, do they really necessarily have until the end of the decade? Because chances are somebody's overbuilding here. But if you are a Google, a Microsoft, an Amazon, you have your own workloads to have to deal with, so you can get useful life out of those data centers that you've got, and you don't have to worry so much about overbuilding. But if you're doing this stuff on spec, aren't you potentially exposed?
Well, you bring up a good point. I do think when that supply-demand curve, finds that balance, that risk is there. We don't have any indicators, though, from any of our sources across all of the supply chain, all the channel checks. This doesn't really matter, John, if it's turbines. It doesn't matter if it's the concrete that they're pouring to build these buildings, or, of course, it's the enterprises consuming this technology that we are going to get there. I spent time with Lisa Su this week at AMD's Investor Day. She's one of the more conservative CEOs we know. She felt very confident in terms of doubling the size of her TAM. Now, that included networking and CPU chips. But that number, that growth number coming from her, she's seeing margin growth. She's seeing her data center number grow. It's growing in every part because they can't find enough supply. So I do think until the music stops.
But I mean, do we have to wait until the music stops? Or if the music just sort of fades a bit, does it start to have an impact? Because a lot of these valuations are not based on a light switch on or off. Is there demand or isn't there? If demand starts to slow down and you see people having to pull their numbers and say, oh, well, maybe we're not as constrained as we were, that's going to have some impact on investors' view on valuations, won't it?
Yeah, I 100% agree. I've been a little nervous about CoreWeave since its IPO. I've said both the combination of a 6-year depreciation model and the fact that they collateralize the GPUs definitely creates risk, especially because there's not a lot of value-added services in bare metal. And we're seeing other hyperscale and, of course, AI utility companies. We've seen some of these Iron Limiteds and other companies that have come up that are doing full stack, offer the energy complex, which is one of the biggest constraints is energy. We have it with memory. And right now, if you're just offering more compute, what we do know is the hyperscalers will use it, but it's not their preference. They're doing it because it gives them immediacy.
Right.
And once they don't have that need for immediacy, all those holding too much capacity are at risk, and that depreciation schedule could cause some real problems.